Thank you, and welcome back to the Briefcase, where we talk all things business, investing, and real estate. Today we're going to go over the real estate formulas you'll actually need, as if you were a CPA. Let's get into it. If you don't understand these 10 real estate terms and formulas, you're not investing, you're gambling. And the problem is, most people don't even realize they're gambling until the deal goes bad. So in this video, I'm going to break down the only real estate vocabulary and formulas you actually need, with real numbers, real deals, and zero fluff. And by the end of the video, you'll be able to analyze a property like an investor, not guess like a beginner. Why vocabulary equals money? Let me show you something real. Two investors buy the same property, same purchase price, same rent, and same location. One says, great deal, 7% cap rate. The other says, wait, this only cash flows $200 a month? Same deal, two completely different conclusions. One focused on the cap rate, and the other focused on cash flow. Only one of them understood what actually matters for their situation. That difference, that's not vocabulary, that's money. So let's break down the only terms and formulas you actually need. No textbook definitions, just how they work in real deals. First is cash flow. This is what everyone is thinking about. This is because, at the end of the day, this is what hits your bank account. The formula for cash flow is cash flow equals income minus expenses. Here's the breakdown. This sounds simple, but this is where most people mess up. Income is not just rent. It includes parking fees, laundry, storage, and late fees. Yes, those count. But here's where beginners get burned. Expenses. Here are the hidden costs. Everyone remembers the mortgage, taxes, and insurance, but they forget vacancy, maintenance, property management, and capital expenditure. A real example, let's say rent is $2,000 a month. Expenses are $1,700 a month. The cash flow is $300 a month. Looks fine. Now add vacancy, which is $100, and maintenance reserve, which is $150. Now that $300 cash flow is actually $50. That's the difference between a good deal and a headache. Number 2, the net operating income. Now we level up slightly. The net operating income formula is NOI equals income minus operating expenses. The key distinction? Notice something important. No mortgage, no financing. NOI is purely about the property itself. Why it matters? This is how investors evaluate the asset, not your personal situation, because your financing is your decision. The property's performance is not. The common mistake, the biggest mistake I see, people subtract their mortgage and call it NOI. That's wrong, and it will completely distort your analysis. Number 3, cap rate. Now we take NOI and turn it into one of the most important metrics in commercial real estate, the cap rate. The cap rate formula is cap rate equals NOI divided by property value. This tells you if I bought this property in cash, what return would I get? The real example, NOI equals 100,000. Property price, 1 million. The cap rate is 10%. The insight, a higher cap rate equals higher returns, but usually higher risk. Lower cap rate equals lower returns, but typically more stable assets. The key insight, homeowners don't care about cap rate. Investors live and die by it. Number 4, cash-on-cash return. Now this is where things get interesting, because most people don't buy real estate in cash. They use leverage. The cash-on-cash formula is cash-on-cash equals annual cash flow divided by cash invested. The example, you invest 100 grand, then you make 10 grand a year. The cash on cash is 10%. Why this matters? This is the number beginners should care about the most because it answers one question. How hard is my money working? The insight? Here's the twist. Leverage can increase this number a lot, but it also increases risk. So higher isn't always better. It's just more amplified. Number 5, loan to value. Now let's look at it from a lender's perspective. Loan to value formula is loan to value equals loan amount divided by property value. The example, the property costs $1 million, the loan $750,000. The loan to value is 75%. Why this matters? A higher loan to value equals more risk for the lender, which means higher interest rates, stricter approval, and more security. The insight? Banks don't lose money because of bad properties. They lose money because of bad leverage. Number 6, IRR. Now this one scares people. IRR, or internal rate of return. This is the simplified version, so let's forget the math. Here's what it actually means. This is your true return over time. Here's your explanation. You invest 100 grand today, get cash flow each year, and sell in 5 years. IRR combines time, cash flow, and appreciation into one number. The insight? 2 deals can have the same profit, but very different IRRs, because timing matters a lot. Now let's put everything together, because knowing the formulas is one thing, using them is where money is made. Number 7, a full deal breakdown. Here's a real style deal. The purchase price is 500 grand. Rent, 4 grand a month. Expenses, 2,500 a month. Down payment, 100 grand. Step 1, calculate the cash flow. The income is 4 grand. The expenses is 2,500, which makes the cash flow $1,500 a month, or $18,000 a year. Step 2, go to net operating income. The annual income is $48,000 a year, and the operating expenses is $20,000 a year. So the net operating income for the year is $28,000. Step 3, calculate the cap rate. The cap rate equals 28,000 divided by 500,000. This is a 5.6% cap rate. Step 4, calculate the cash-on-cash return. The annual cash flow is 18,000. The cash invested is 100 grand. The cash-on-cash return is 18%. Step 5, the loan to value. The loan, 400 grand. The value, 500 grand. The loan to value ratio is 80%. Step 6, calculate the internal rate of return. If rent grows, property appreciates, and you sell in 5 years, your IRR could be significantly higher than 18%. The insight? You're not just guessing, you're analyzing. And finally, number 8, mistakes to avoid. Mistake 1, confusing your profit with your cash flow. You can be profitable and still run out of money. Mistake 2, ignoring vacancy. If your model assumes 100% occupancy, you're wrong. Mistake 3, overestimating rent. Everyone always thinks, I'll just raise rents. But guess what? The markets don't care about what you think. And finally, mistake 4, forgetting about capital expenses. Roofs don't care about your spreadsheet. So finally, you understand cash flow, net operating income, cap rate, cash-on-cash return, loan to value percentage, and internal rate of return. But here's the question. Which one actually matters the most? Who's to decide? And finally, a quick fun fact before we keep going. And this one might actually change how you look at real estate forever. Most people think real estate is about buy low and sell high. But that's actually not how investors get rich. The real formula, the ones pros quietly use, is this. You don't make money when you sell. You make money when you buy right. Yeah, seriously. There's a saying in real estate. You can't fix a bad deal with good management. Which means, if your numbers don't work on day one, no amount of rent increases, renovations, or optimism is going to save you. That's why the formulas we're talking about in this video, cash flow, cap rate, ROI, aren't just math. They're your filter. They tell you before you buy whether a property is going to make you money or slowly drain your bank account. And here's the crazy part. Two investors can buy houses on the same street at the same time. One builds wealth and the other loses money. The difference? Not luck, not timing, just knowing the formulas and knowing what is right. And thank you for watching the briefcase today. If any of those formulas or vocabulary words confused you or were insightful, please leave a comment down below. And if you enjoyed this video, please like and subscribe. Now remember, stay smart.